Hello everybody and welcome to this video where we'll be running over the top 5 banking institution companies. We have selected the following 5. The first one, JP Morgan, stock ticker JPM. Next one is Wells Fargo, stock ticker WFC. Then we have US Bank, stock ticker USB. We then have Citigroup, stock ticker C. And finally we have Bank of America, stock ticker BAC. First, we want to understand how these stocks have been performing and whether they're in what we consider up or downtrend. And as we can see for the banking stocks here, they have all been hammered quite a lot for the past years or so due to a lot of different factors, among others the low interest rates. So if we take a look across the board, year to date, JPM has lost 32.95%. WFC has lost 56.06%. USB has lost 40.7%. Citigroup has lost 47.4%, and BAC has lost 33.3%. So all really looking towards a downtrend for these stocks. They have not been performing well. Next, we want to look at the income statement and first understand if these companies are earning any money in the end of the day. So we can look at the net income and we can see across the board that all these companies are earning money. So that is really good. However, if we look at the net profit margin for the last 4 quarters, we can see that even though they are profitable, they are still not that good benchmark against the industry. However, some of them are performing well better than the others. So JPM, USB, and BAC are performing much better than Citigroup here on 12.36% and WFC, which only has 3.02%, so really not good. The BNSM score, not really relevant for the banking institutions, that is not applicable. Then we have the Sloan ratio, which identifies if a substantial part of earnings are non-cash accruals, and we want this to be between -10 and 10%. And as we can see here across the board, we are in that range, so that is really good. No reasons to concern. So first we took a look at the stock trend, and what we could see that all of them were in a negative downtrend. On the income part, all of them were positive, which was really good. On the net profit margin average for the last 4 quarters, USB has done the best, followed by BAC, JPM, C, and then finally WFC here. We then move into the return section, and basically we want to understand how high returns and cash flow margins is being generated by these companies. So we can first take at the earnings yield, which is benchmarked against the S&P 500 average, and we can see here that JPM, USB, C, and BAC are actually doing fairly fine here. They're better than the industry average, while as WFC is doing okay, but nothing really outstanding compared to its competitors. Then on the return on invested capital, we can see that JPM doing well, WFC again doing really bad here with -2.69%, USB has an okay acceptable one on 1.24%, Citigroup only 0.49%, nothing really noteworthy, and BAC 1.06%. So again, nothing fantastic, but good compared to the industry. Last, the levered free cash flow margin here, we can see this is really good across the board with the exception of Citigroup, which only has 2.59%, so really poor. The one that is outstanding here is BAC with 65.25%, really good number. Next, we want to move into the balance sheet to understand how strong the financial positions are of the companies. And again, we can take a look at the current ratio. However, this is not as meaningful for banking institutions because current assets and current liabilities in general are very difficult to assess for them. So it's not really telling any final story here, even though most of the numbers are red. On the cash ratio side, I would like that to be above 1 if possible, but again, similar story here. It's a bit difficult to assess for these type of companies, so I will leave that one out. If we go into the total assets versus total liabilities, again, for banking institutions, not as important because what are the assets that they have, and so again, a lot of them will not perform as well as other companies which has higher type of assets or a more assets-driven industry. So we can see all of them are more or less having the same here. So again, it's more important for me to look at the debt-equity ratio. And what we can see here is the JPM scoring fine with 1.2, WFC okay with 128, USB really good with 0.81, Citigroup with 1.45, and BSE with 0.98. So overall, across the board, I would say that it is looking really well. The Element Z score, which is the credit test that assesses the likelihood of bankruptcy, is not really relevant to use for banking institutions as well. So we can take a look at the Pure Trustly score, which assesses the financial strength of the company, and all of them are at 5 or above. So again, even though there's a lot of red numbers here, there's really no big concern for me as of today. So back in the overview, we first look at the return metrics and the return on invested capital, and what we could see was that JPM, followed by USB and BAC, were the best. On the leveraged free cash flow margin, BAC was by far the best, followed by JPM, WFC, and USB, and the one from Citigroup was really, really poor. Next, on the balance sheet and the title ratio, where all of them were more or less the same, we saw that USB and BSC had the best. However, again, they were almost identical, so they should almost have the same score here. Next, on the debt-equity ratio, USB were the best, followed by BAC and then JPM. Next, we want to take a look at the shareholder yield and basically how much value is returned to shareholders through either dividend and or buyback. And first we can take a look at the dividend yield here, benchmark against the industry. We can see that JPM paying a really well 4.29%, WFC 8.28%, really generous, USB 4.67%, C with 6.03%, and BSC with a small 2.95%. Again, the banking industry is in general known to pay really well dividends, and of course the percentage here will appear higher because the share price have dropped so much and they have not cut their dividend payment. Next, take a look at the buyback. Looking really well across the board. It's a small 6.02% for JPM, but otherwise we're in the double digits here, 25.49% for WFC, 13.01% for USB, 38.56% for C, and 28.82% for BAC. So really, really good numbers here. But we obviously want to understand if these payments to the shareholders are sustainable. So we take a look at the modified payout ratio. And basically it shows the proportion of earnings paid to shareholders in the form of dividends and buyback. And we want this number to be below 100 because that means that it's sustainable. We don't want it to be above and we don't want it to be negative. That is above 100 doesn't mean that it's totally bad. It just means that it will not be sustainable to keep paying this in the future. So JPM here is almost reaching its maximum on 97.22%. So that's all right. WFC 140.05. It's a red flag. However, I would say that they could by far cut down the buyback to make this number more sustainable, so I wouldn't be concerned with the dividend part for them. USB here really good on 60.08%, so that means that they can increase further their dividend and or buyback if they wish to. Citigroup here minus 364, it's really bad number, so I would really be concerned. I wouldn't take the total shareholder yield for granted at all. They will have to do something. And BSE here 101.55, that is all right. Next, the earnings per share and growth section. Can these companies grow in the future? Will they continue to grow? First, we can look at the price earnings ratio here, how much you're paying for the stock. JPM, a little bit of a higher than the industry benchmark. WFC, a lot higher. It seems a bit expensive, the 27.01. Also with the numbers we have been seeing so far. USB 11.05. It's similar to JPM. Citigroup has a really attractive P ratio on 7.27%, and BAC is more or less in the same range as USB and JPM. Next, really important one is the EPS growth forecast for the next 5 years. So how much do they expect to growth on a compound annual basis? JPM expected to go back. WFC will have the largest increase here on 3.73%, so that's a little bit uplifting compared to a lot of the other numbers that we have been seeing. USB 2.46, Citigroup will go back 3.27, and BSE will go up 2.36%. So again, not huge growth industries, which is obviously also a consequence of the poor interest rate market that they are facing this time, which is expected to continue for the next years. So again, I also think it's interesting to look at the revenue growth for the past 5 years. You cannot use the past to predict the future, but it is still worthwhile to take a look at it, how it has developed. And as we can see, JPM was the one grows the highest with 5.93%, and the worst one was WFC with 0.86%. The rest was in the range of 2.5 to 4.3. Again, I think it's very interesting here to take at the net profit growth for the last 12 months, because that kind of illustrates really well why these companies have been struggling quite a lot. So again, JPM has decreased with 23.94%, WFC with 81.68%, really a red flag here, USB with 28.23%, Citigroup with 21.54%, and BAC with 31.93%. So I think this tells a really great story of why the stocks have been falling so much for these companies. Next in the overview sheet, we looked at the shareholder yield. And basically the ones who were paying the best based on my assessment is Bank of America, followed by USB, JPM, Wells Fargo, and Citigroup in the end. Again, all of them besides Citigroup appears to be fairly okay place. However, the net profit margin decrease that we just saw on Wells Fargo was actually a bit more of a warning sign for me in regards to them. Next, the earnings growth for the forecast for the next 5 years. We saw that Wells Fargo is actually expected to do the best, followed by USB and Bank of America. Maybe Wells Fargo is expected to be doing the best because they have been doing so poorly in the past. This was also reflected in revenue growth for the past 5 years, where JPM was doing the best, followed by USB, BAC, Citigroup, and then Wells Fargo in the end here, which has been performing pretty poor. Next, we want to understand the valuation of these companies and whether they are currently considered over or undervalued. And one way is to look at the PEG ratio and the Peter Lynch fair value, which basically says that if the PEG ratio is between 0 to 1, they are considered undervalued. If they're above 1, they're overvalued. And if it's a minus, then we cannot calculate it simply. So if we look across the board here for the different companies, either we cannot calculate it or they are all considered overvalued from this perspective. Then we go into my own fair value intrinsic estimator. So basically it's based on a lot of different assumptions and numbers that I try to derive to the intrinsic value of these companies. And with the safety margin, of course, included, it's actually quite interesting because for all the companies, it shows that they are currently undervalued. And WFC with 14% and C with 21.89%. But in general, all of them are considered undervalued. So that's a good sign. On the beta risk, it's basically just the stock volatility in relation to the overall market. So if this number is above 1, they move more than the general market. And as we can see across the board, all of them are above 1, but they are not extremely volatile, just a bit more than the general market. Next, another value is to look at the book value per share. And basically, if it's above 1, it's considered undervalued. If it's below 1, it is overvalued. JP Morgan, JPM 0.91, so they are considered overvalued. WFC here 192, so that means that again they are undervalued from this perspective. USB 0.97, overvalued. And then we have C and BAC, who are also both undervalued, so really good signs. The next is to look at the relative strength index for the 14 days. We want this to be below 30 because that means they're oversold. We don't want it to be above 70 because that means that they're overbought. All of the companies are in the middle range, with the exception of C, which on 25.73. So again, a really good indicator that this stock may be undervalued compared to its current price. Next, what are the analysts saying? I'm for sure not following them blindly, as you have seen in some of our other videos. However, I like to stay on the safe side and in general, and also follow their kind of like consensus. So basically, we have the consensus price target down here, which is the middle ground of all the estimates. So we have a buy target on JPM with a 19.17 upside. WFC has a hold, but a 42.19% upside. USB 46.55. So again, an upside of 32.10%. C, again, has an upside of 73.66. So there's a lot of expectations from them, from the analyst. And then we have BAC here and then with an upside of 26.96%. So again, looking at all these valuation, it actually shows that these companies may be an attractive play going forward. So just to wrap up on the ranking overview, we looked at the intrinsic value, and based on an overall value assessment, I believe that JP Morgan is fair valued as of today. Wells Fargo, a little bit undervalued. US Bank, fair valued. Citigroup is undervalued, and Bank of America is considered undervalued. So to round off some of these banks that has been struggling quite a bit on the share price side for the most recent periods, we believe that there's some value to be gained from some of these stocks going forward. So based on that, the following top pick of today is based on a respectable average net profit margin of 17.56%, an outstanding free cash flow margin of 65.15%, low debt equity, currently attractive dividend and buyback yields, which is relatively sustainable. It is undervalued on several parameters. We have selected Bank of America. So although this may not represent the highest upside potential, we believe that based on a risk trade-off, this is a very good play. And we would not be concerned to go into Bank of America based on what we are seeing on the numbers. Next, the other pick is Citigroup. We believe that short term, there will be a lot of gains on this stock. It is not necessarily something that is sustainable for the longer period. So therefore, we want to put the flag about that this would be a short term trade for us, not to keep for an extensive period of time. If you want to go for dividend investing, I would say that both USB but also JPM are fairly good plays. WCF, Wells Fargo, we would stay away from them as of today. They have also been involved in major scandals over the most recent years. So again, we would stay out of them as of today, but the rest can be justified to move into based on different reasons, so to say. That was all for today. We hope you enjoyed this video. Please comment, like, subscribe for future content. Please also check out our Patreon site where we post a lot of additional bonus content. Otherwise, nothing to say than have a great day. Thank you.